Hello, everyone, and welcome to Money Show's virtual event. Next up is Darren Davis, the co-founder and principal of Presario Ventures, who is going to tell us about the next 10 years and 3 whys for multifamily profits. At the end of the session, we're going to take a few questions, so if you want to type them in the box on the right side of the platform, we'll address those towards the end. So, Darren, thanks for being here today. Sir, you have the floor. Please take it away.
Great. Let me get the start video.
There you are.
Yeah. All right. Good morning, everyone. Hey, thank you very much for spending the next 30 minutes with us and learning a little bit more about Presario Ventures, kind of what we've done in the past, a little bit about our business model and what we plan on the future, and why we're so bullish on commercial real estate, especially multifamily here in the Texas marketplace. Wanted to just go ahead and share the screen now and talk to you about what's really happening we see in the next 10 years and why we like Texas and why we like multifamily so much. And got a little bit of a delay here.
I'm seeing your slide just fine, just so you know.
And I'm trying to get to the next one.
Okay.
And we'll give it 5, 4, 3, 2, 1. Let's see if I can make it go this way. There we go. All right. Let's talk a little bit about multifamily and the strategic opportunities that we see. Now, we are primarily focused in Class A development. And a couple of reasons are this. One, we saw that the Class B and Class C markets were getting very, saturated with a lot of what we'll call new money coming into the program. And a lot of that market, if you guys remember about the last 3, 4, 5 years ago, everybody was doing a C product and flipping it into a B, or doing a B product and flipping it into an A. And what's happened is that a lot of that market has gone away. We had stayed in the Class A multifamily, but we also stayed in, we had really key metrics that we stayed in. One, we wanted to stay in the secondary markets. That's the suburbs of the major hubs: Austin, Dallas, Fort Worth, San Antonio, and possibly Houston. We like the multifamily real estate also because we've got a 20-year track record providing very consistent returns. And we really stay down the fairway. We kind of understand, where our risk reward is. We're very risk adverse. We're about capital preservation, and we understand how to make those returns. We also look at the types of equity. And if you haven't heard this phrase before, there's common equity, which is typically what you'll see is just your basic equity that goes into a project. And then there's preferred equity, which has become a little more popular since the pandemic, where people are saying, you know what, I may want more of an assured return. I want it to be more short term. I may not get the upside as the common equity would provide, but at least I know what I'm getting and how long my money's going to be out. We also look for opportunities that make sense for us. Jobs. I can't say it enough. If you look at the state of Texas and you look at all the growth areas inside the state of Texas, it's those communities that can provide jobs. We're very fortunate here in Austin. I can't say we're the smartest guys, but if you look at all the relocations and the job growth that we have here in the Austin metro, Dallas, Fort Worth, the same thing. We're just very fortunate to be in the state of Texas right now. We also look for, where's the opportunity? You can go into some of these true secondary markets and even tertiary markets where product hasn't been built in 5 or 10 years. And you can see the infrastructure that's going out there with roads primarily and new companies being relocated more out into the suburbs. And that's become a very big opportunity for us to say, where's the next big upside? And I actually have an example I'm going to show you guys here towards the end of the presentation. And then I've got to just bring this up. Debt has kind of been one of the things over the years that's going like, is debt good or bad? In today's market, I can't stress enough that debt is an asset. It's a fantastic tool. And if you get the right debt structure, you can have multiple exits. And we'll talk a little bit more about that as well. Here's our 3 whys. I just think this is so important to understand what's happening. First of all, we talked about the debt. Today, if you're looking at interest rates that are sub 3, high 2s, that's almost free money. And if you can secure some really long-term debt, you're really looking at a way that you can grow your asset and grow your cash flow. There's even products out there now today. If the asset is well received by the agencies, you'll be looking at, getting 2 years, 3 years, 4 years of interest only, and you can really build your cash flow there. The other one is that we've used a lot is Hud Insured Debt. This is debt that's trading right now, or interest rates right now are in that 2.5% range, maybe high twos, but you can lock into 35 and 40-year term. So if you're a long-termer, and in some of our assets we are, we'd like to get that HUD insured debt, and you look at that amortization schedule that goes out 35 or 40 years, and you look at that low interest rate, that also helps on the cash flow. Housing demand. State of Texas, we see at least a 10-year, and in some cases you'll read reports saying that we have a 20-year shortage of housing, that the supply cannot keep up with the demand. If you look at the growth that we have in the state of Texas, we feel very fortunate and we feel very lucky that we're here, but we also understand where the growth is going. And primarily for us, if you'll look at, and we'll show you this map in a little bit, if you look at the I-35 corridor, which runs from North Dallas, North Texas, the Dallas-Fort Worth area, straight down through Waco, down through Austin, down through San Antonio and into Mexico, that is where most of the growth is happening. We also have, if you look at commercial real estate, in one of the most safest, secure investments, it has a great historical track record. We do as well. It's a proven asset, and we just like that. So the 3 Ys, the debt, demand, and the proven returns. State of Texas, give you a little bit more information on this and why we like it so much. I mean, we consistently have job growth. If you look at the companies that are relocating here, we now have 50 of the Fortune 500 companies that have moved to Texas. And like I said earlier, it's all about jobs. At the end of the day, it's about creating high quality jobs. Now, if you look at that bottom bullet point, I think this is pretty amazing. Our population is just under 30 million today. In the next 30 years, it's projected to be at 54 million. That is just massive, massive growth. So we feel pretty good about being here in the state of Texas. Want to show you some of our projects that we currently have. This is 7 projects that are currently in our portfolio. I'm not going to go through each one of them, but what I'm going to share with you, all of those are on the I-35 corridor, all the way from Vista Razor Ranch in Denton, Texas, which is north of Dallas-Fort Worth, all the way down to Exeter Place at the bottom, which is in San Antonio. This is something that we're really consistent. And when we talk about capital preservation and being conservative, we're not the type of group that's going to take a lot of chances. But what you're going to see us do is, per project, we typically raise between 5 and 10 million per project. And we're doing probably 4 projects this year, maybe 5. You know, we're not a burn and churn shop, but we're going to raise between 5 and 10 million. Our average hold time is between 3 and 4 years. The multiple, meaning if you put in $100,000 into an investment, what would you see back in that 3 to 4 year time frame? Somewhere in that, 1.4 to 1.6. Do we exceed that? We do. Sometimes we'll be at that 1.7, 1.8, but we're really not going to underwrite for that. We're going to tell you in that 1.4 to 1.6 is where we are. And the IRR that you're looking at is typically in that 14 to 18%. I want to give you a couple of examples of some projects that we've done and what we do and how we look at this. This is one that we did in Austin, Texas. This was a little different, and I'll tell you why we like this model, but this model's not for every investor and not for every asset. First of all, we do the development, and then usually towards the end of year 2, beginning of year 3, we start to cash flow that project. If we like the project and the project is appreciating significantly, as it did with this one, it wouldn't be uncommon for us to say, hey guys, let's do a refinance, pull out some of the cash, continue to hold the project and cash flow it. So under this model, that's what we did. We actually cash flowed the project, did a refinance. By the time we did the refinance, everybody had received their original investment back. We've continued to hold it for cash flow, and we're probably going to sell it this year or next. And if you look under where it says retreat at North Bluff, Austin, Texas, right under their projected 3.7 multiple return, So everybody under this project would have gotten a 3.7 return on their capital. Now, you may or may not know this, but one of the big reasons we like the refinance, when you pull the cash out of a project like this, or you do that model, that money is non-taxable. So we like playing in an arena where we can minimize our taxes at all costs. This is one that's a little newer here in Lockhart, Texas. So when we talk about develop, cash flow, sell, and the multiples that we're talking about, this one's going to do better than that 1.4 to 1.6 multiple that I told you about. We did develop this one. This one did lease up fairly quickly. In fact, we were at 99% occupancy within 6 months. And one of the reasons why, there had not been a new product built in Lockhart, Texas in over 10 years. So when we built, we just had a wave of people coming in, and for the sheer fact that we're on the southeast side of Austin and about 20 minutes from the airport, and about 20 minutes actually from where Tesla just announced their new, one of their new factories. But on this one, we'll develop, we'll cash flow it, we'll sell it. And this one will be about a 2x return. And this one will probably sell sometime at the end of this year. So when I talk about, let me back up just a second here, but let me pause. We do not currently have an investment to show you guys. We have 2 of them that are pending, but I wasn't prepared to bring those to you because it's not 100% that we have those assets ready to go. But I wanted to show you the type of deals that we do, whether we do a development sale or we do a development and a refinance and a sell. Those are both common investment models for us. Now, eligibility to this is for accredited investors only. And for the MoneyShow, we are doing a minimum of $25,000. We typically have a $100,000 minimum. And for first-time investors, we have a $50,000, just so we want people to get comfortable with us. But for MoneyShow and talking with the people that have been through the MoneyShow program, and we agreed, we thought that $25,000 on a first investment would be appropriate with us. If you're interested in investing, if you'll look at the offering website under the offer details or view the link under the deal terms inside that, click on that and just provide us your information. And what we'll do is we can either, one, show you examples of offering memorandums that we've done, case studies that we've done. And if nothing else, we'll have you on our list when our next offering comes out, which should be in about 3 or 4 weeks from now. So that's, you know, and I think if you want to go to info@presarioventures.com, that goes into our marketing group, which actually will respond to you with any questions, or it'll be forwarded over to myself or my business partner. So with that, I wanted to give you a high level look at what we do and who we are. Any questions, please ask. And I think we'll take those on a, I think, is it Greg?
Yes, sir. Yes, sir.
So if you've got if any questions are coming in, or if you have any questions that you may think need to be prompted, we're ready to take those on.
Well, great. Yeah, we don't currently have any questions, but I encourage everybody watching to please post those now, and then we'll address those here in a few minutes. Somebody mentioned to me, Darren, that your new partner, Tom Burns, has come out with a new book, Why Doctors Don't Get Rich.
Yeah.
Can you tell us about that?
Sure, I'd love to. Yeah, Tom Burns has been we met 20 years ago, and the irony of that is that we started investing together, and the next thing you know, we found ourselves being business partners. And Tom is a practicing orthopedic surgeon. His book is this one right here, Why Doctors Don't Get Rich. And if you really want to know who we are and what we do and how we think, here's the blueprint right here. So Tom's done an excellent job with this book, laying it out. It's really simple. It talks about cash flow. It talks about risk reward. It's just a fantastic book. And I think we actually have that in our booth, but if not, please contact us and we'd love to get you guys a copy.
Okay, great. Thanks, Darren. And maybe at the end, you might want to show that book when we stop sharing your screen so they can see the cover a little better.
Okay.
But for now, we've got a couple questions. So Mark wants to know, is the investment guaranteed through the asset?
Is the investment guaranteed through the asset? So if I think I understand the question, it is. There's not, if we are not guaranteeing, like Tom and I do not guarantee the asset guarantees the investment. Now, what I can say with that Have we ever lost money on one of our deals? We have not. So we actually are very proud of that record, that every deal we've done has returned capital and a positive return.
Great, great. Let's see. We have another one. Richard wants to know, who are your main builders?
General contractors is what I'm going to think that Richard's asking there. We don't have one go-to general contractor, and I'll tell you why. We primarily play the role in a development. You have the general contractor, you have the developer, you have the debt, and you have the equity. So we understand the debt is, Fannie, Freddie, any of the big debt brokers that are out there. Then you have the general contractor, and that's usually chosen by the developer. And then you have the equity, and that's the role that we play in the game. So we're not really, now, do we approve the general contractor? A lot of times we do. We get in early enough, but we don't have one group. We've used one group twice, another group twice, and then 4 other individual groups.
Okay, great. Let's see. We have another question from William. What is the lockup period?
Good question. There's a kind of 2 answers to that. There's not an actual lock up or lock out period for somebody's money, but I will tell you, this asset is not very liquid. We've had a handful of people over the years say, hey, I'd like to get my money out of the deal for whatever personal reason they've had. And we've been able to accommodate. Usually it was something, personal, medical, or something that we were able to help the investor. But this isn't something you can take onto the market and have a like the stock market and sell it on the open market. You would be selling it internally through the partnership group, but it's not. If you think you need the money in the next 3 years, I wouldn't make the investment, because it's just not a really liquid investment.
Fair enough. Yeah, Michael asked, can investors get their money out if they must liquidate? So I guess in a rare situation, they can come to you, and you'll try to find some ways to help them.
Yeah, we've had a handful of times that's happened, and we absolutely understand. So, and we've been able to accommodate every time.
Very good, very good. Moyne wants to know, the deal coming in 3 to 4 weeks, can you share some details, the location, the type of returns, the hold period? Thanks.
Here's what I can share with you. It's in that 3 to 4 year range. It's going to probably be one in San Antonio and one in Dallas. Those are the 2 that we're looking at right now. We do have one in Austin, but it's about probably 8 months out still, because we were actually acquiring the land and actually going through all the entitlements. So San Antonio's first, Dallas is second, and then Austin would be probably into Q3.
Thank you, Darren. We have a question from Richard. What potential changes in the law might the Biden administration support, which may alter the risk-reward equation?
Good question. It's all speculation right now. And I'll just give one as an example. Probably this one's made the news quite a bit. The 1031 exchange, if people understand, that's where you sell an asset and you put it into another one to defer your tax gains. There's talk about anybody over $400,000 not being able to take advantage. If you make $400,000 in income, not being able to take advantage of that 1031 exchange. I don't know how many people that will impact, but that's one that's on the table. I think one of the bigger ones that's out there is the capital gains. It's going to be interesting, because I think capital gains right now are in the mid 20s, and I think the Biden administration is low 40s. That's pretty significant. And if you talk about not being able to sell an asset, or if you sell it, then you go into that 1031 to go into another asset, but how many people can actually go into it? So I think both of those, primarily the capital gains that would impact everybody, would be significant on the industry from an investor standpoint. So you might see more people holding cash flow and then refinancing the asset versus selling the asset. Because once you refinance it and pull cash out, that's not a taxable event. And we've done that model, and we like that model.
Okay, Darren, we've got a question from Mark again. How much do you have a stake in the investment property?
Do you think how much do I personally have at stake?
I think that's what he's asking.
A lot. So, I guess, has anybody ever heard the term, you eat your own dog food? So we are completely invested into, into this. Cash wise, I would say, gosh, 60% of my assets, are in the assets that we're building. 60 to 70% of the assets are in the assets that we have the 7 that you saw there. And that's, but I feel like I understand the business really well. And I feel that I'm diversified into one of the best assets that I could possibly be into.
A lot of confidence there, and because you know the business, and certainly in the one coming up in 3 to 4 weeks, you'll be an investor in that as well, I'm sure.
Absolutely. Yeah, we're heavy. We're heavy in these deals. Very heavy.
Very good. Let's see the next question from James. Can these go into IRAs?
Yes, IRAs can invest with us, and I would say we typically see about 10 to 15%, maybe closer to 10% of the money in each deal that we have come into IRAs. One thing I will share with the person that asked that question, if you are investing in an IRA, pref equity is an excellent IRA investment. So if you're looking at common equity, pref equity, and you have that option, we typically would tell our guys, hey, if you've got cash and IRA cash, use your cash for the investment because of the tax deductions you get. Use your IRA, or I say tax advantages, use your IRA, which is in the short-term income bucket where you're deferring those taxes, because you can't take advantage of the tax benefits with the IRA money. So you typically, if you're really looking to gain, as much value on the investment as possible, then you want to use cash for the common equity, and any type of loan product or preferred equity, you want to use your IRA.
Fair enough. And for those that don't know, I know there's some companies out there that you can become your IRA custodians to do these kinds of investments. For example, Nuview, Nuview. I actually use them for some work, and there's a couple others out there, I believe.
A good one. And yeah, we know the top 4 or 5 with our investors who bring their money to us. We've gotten to learn them very well over the last decade.
Right. Well, it's a good resource for your investments. So Michael wants to know, how and when do you make distributions to your investors?
That's a real good question. So I'm going to give you 2 answers on that one. When we do a development, distributions are not really expected until the end of year 2. And the reason why, we have construction, lease up, stabilization. Stabilization usually happens at the end of year 2. Okay. So you're not seeing any big, and then when you do see cash flow, it starts off on that 2 to 3%, and it grows the next quarter and the next and the next. Okay. There's 2, and then the next answer to that is there's 2 loan products out there, and I'm just going to call it conventional and HUD insured. If we're under a HUD program, it's twice a year. If we're under a conventional program, it's quarterly.
Okay, Darren, let's see. We've got another one. Bear with me a second here. L. Merrill wants to know, how much concern is moratorium on paying rent? I think maybe talking about allowing renters to delay paying due to the COVID pandemic.
Yeah, that's a great question. And that's one that's been kind of just haunting us a little bit. We're very fortunate that we have, in the last 9 months, the worst we got was 2.5% default rate. So we didn't have where some of the other markets were seeing 10, 11, 12% on the, eviction moratorium. I'm not up to date on this, but I saw a headline yesterday that a judge said that was not constitutional. You couldn't do that to the, now again, I haven't read this, and I will be reading that today, but I want to find out what that is. But for us, we've been very fortunate. We just have so much demand for housing here. And we're not in the BC market. I think some of the C-class products got impacted a lot more than the A-class suburb products did. So fortunately, it hasn't been an issue, and we don't foresee it being a big issue for us going forward.
All right, thank you. William wants to know, how much price appreciation are you assuming? I think he means on the property assets, right?
Yeah. You know, that's a good question. And what we look at these things when we underwrite them, we typically underwrite with expense growth at 1.5% because we're in a new product. So our expenses aren't as high in the first 5, 6, 7 years. And when we get into a new product, our income, could be 2 or 3% increase per year. So we typically write our rent increases at 2% a year, our expense at 1.5 to 1% a year. So on the appreciation side, 2%, 3% per year. I'll tell you this: that one project that I told you that we refied it and pulled it out and then still cash flowed. If you remember from 2011, when everything was depressed, from 2011 to 2014, that asset went from 20 million to 30 million. So, which was huge, huge. Now, do I expect that going forward? I don't. But I think in this market, we're going to see healthy appreciation year in, year out for a period of time, at least a decade.
Very good. David wants to know, there are other areas in Texas that can use type A housing projects. Have you looked on the coast, Padre Island, Corpus Christi? There's a lot of growth and land is cheap.
Yeah, and I'll tell you why. No, I would give anything to be able to, and I love Corpus Christi. Jobs are fantastic down there. Since Hurricane Harvey and underwriting for hurricanes and floods and insurance, it has been a challenge. We had this spike in lumber prices as well. We had to walk away from 2 projects that we had spent a ton of money and time on because lumber prices had gone up. So the metrics for just cost and income rents have not worked out like they have in Austin or Dallas. And Hurricane Harvey was pretty damaging. And this ice storm that we just had, I don't even know. I mean, that just took the whole state down, and it was real. But we do like the coast, but it just hasn't. The economics just haven't worked out lately.
Fair enough. We've got about 3 minutes left, and we do still have some questions. By the way, Michael asked, please send me info. Michael, in the virtual booth, once we end the session here, use the request form and give your contact details, and I'm sure Presario folks will get back to you there.
Yes,
yep. Sorry. William wants to know, what are returns on preferred equity?
It's a good question. I'll tell you what the industry is. On preferred equity, you're seeing anywhere from 8 to 12%. On that, and it's typically paid quarterly, and it's typically about 2 to 3 years. We're seeing for our projects, for our multifamily projects, we're seeing right about 10%.
Very good. So it looks like we've got 2 minutes left. We've got a question here from Richard. For Roth IRAs, do taxes play into investments in your products apply? I'm not quite sure I understand that question.
You know what? Is that Richard asking that question?
It is Richard. Okay,
Richard, that is, I'm having this epiphany because yesterday I'm thinking of that same thing for the Roth. And I said, I need to go research that because somebody's going to ask me that question. And I don't know that answer, and I apologize, but I'm going to research that today. And I will have a written answer or a link to send you to that will give you the information I think you're looking for.
So, Richard, you might want to put a request info form through that lets him remind.
Yeah, I literally was thinking for myself too.
Because, yeah, very good. Yeah. All right. Well, I think we're out of time, Darren. It's been a great presentation, very interesting information.